All right, hello and welcome back. We are geographically in a different place stock-wise today. Just thought I'd have a bit of a change. Obviously, everything so far has been US-based companies, but I put together a Lilu Monish Pabrai type screener in where you're basically looking at the worst performing stocks. I'm looking on TradingView on their screen, and basically the whole UK market, all the indexes, pardon me, and anything that's had like a year-to-date performance of sub 30%. So I think you can actually set it up to go to search for lower, but we're looking sub 30% just because it was the lowest available metric on there. But like I said, there is a manual one where I think you can search even lower. Market cap over 10 million, because basically every value investor out there talking about trying to find decent stocks was all, like repeatedly stated that most of the stuff that you're going to find is not going to be in the, blue chip area. For cheapness, it just generally doesn't happen. And I have read several times, and I think Joel Greenblatts stated that you sort of need to be looking at the sub 1 billion market cap, because after that, that's when the larger funds and all that start getting involved, because if they can't buy a big enough position, it doesn't make a material difference to their returns. So generally they're not interested in the smaller stuff, which is where the money can be made for the smaller guy. You'll find most large value investors telling you that, Joel Greenblatt, Lilu, Monish Pabrai, generally looking in the weeds where nobody else can fish, or the waters where nobody else can fish. Should have said that, shouldn't I? What an analogy that would have been as opposed to the one that I chose. So what I stumbled across straight away was B&M. B&M is quite a large UK retailer. Greggs is on it as well, which is obviously a British institution, so I might look into that again in a minute. But yeah, price looks terrible, but you are at, you've flirted with recently all-time lows. There has been all-time lows by the look of it recently. So yeah, I pulled this up because initially, I don't know if I've got my spreadsheets open. So where are we? I got it on the wrong screen. Here we go. B&M, just for those of you that don't know, it's merchandise grocery, tends to aim towards the lower income market generally, although most people are shopping there because you get exactly the same products. It's just they occasionally appear to be cheaper in B&M. 701 stores in the UK. 311 stores under Heron Foods and B&M Express. Not really sure what that is, so we'll look into that. And they've got 107 stores in France. So obviously the vast majority of their business is in the UK. Looking at their revenues, I've got a funny feeling there's only a few 100 million of this that's actually in France. I'll have to, we'll check on it. But, initially, initial take, B&M looks really good in the return on capital is really good. I have already looked at this. I should say I have already looked at this and had to do it off screen because I couldn't get the pardon me. I couldn't get the freedom to do it without noise in the background. So I have looked into this previously. But yeah, the return on capital looked really good. Simple free cash flow looked really good when you consider, so what we're saying there, like 500 million when you consider, market cap. So that'd be like less than 5 years and you could buy the company. This is where actually I stumbled into quite a big learning block, which I was aware of anyway, because we have spoke about it, but I'd never dug into the weeds of it. Now, IFRS 16, which we've brought up before, because it's obviously put leases on the balance sheet. So now balance sheets look far more leveraged than they are. In the UK and the EU, basically, it seems anywhere outside of the US, lease expenses were moved from the on the cash flow statement. Lease expenses were moved from the operating portion down to the financing portion. Now, this obviously lease expenses would have been subtracted, so it wouldn't have affected free cash flow. While the Americans, by the sounds of it, kicked up a bit of a fuss when it got moved down to the financing, because it ruined metrics and the ability to look at historical metrics, because all of a sudden, if there's no leases in here and you're only taking away capital expenditures, then all of a sudden your free cash flow looks artificially inflated because you've not actually paid leases. Well, leases were moved down into the financing cash flow statement everywhere in America. Americans kicked up a fuss, which I think rightfully, and they won. I say they won through. I don't believe they wanted the leases on the balance sheet either, but that did end up happening. There was some sort of compromise. So the leases are in the operating section of American cash flow statements, but in everywhere else, annoyingly, they're in the financing section. So what actually happened is that this free cash flow was hugely inflated because when we bring up, have I got it up? B&M's financial report. So we go on the annual report. I'll try and find it in a minute. It's way down the list, and unfortunately, there's no sectional. There we go. So get down to the cash flow statement. The leases are here. So you've got 176 million in principal and then 77 million in interest. So you've got over like just over 250 million that should be, in my opinion, and obviously in the Americans' opinion, in the operating section. So actually the operating income is significantly less. So what I've had to do is modify my spreadsheet, and I've had to put in a lease area and to take away from the free cash flow, because without going through this individually every year and then taking away the exact number that was on the cash flow statement, it makes it tricky, which is where the Americans were I believe rightfully kicking up a stink. So what I have done is I've gone to the cash flow statement. I checked with ChatGPT. ChatGPT says it's fine, so we're going with that. But what I've done is I've gone to the cash flow statement. I figured out what percentage of leases was to revenue, so like a lease margin effectively against the revenues, and then I've used that on every previous year. So it was around 4.5%, but to be conservative, I've said it was around 5%. So you've got to be conservative. If you're in value investors, I believe you've got to be conservative in your analysis and in your forecasts and all that. So the lease expense is actually slightly higher this year than what it actually is. But then that is then taken away from this free cash flow, and then all of a sudden we're doing the same metrics that we do here, like the yield, the multiples, the return on capital from the now adjusted free cash flow. So obviously we've got a 30% Joel Greenblatts return on capital here, but when you actually take the lease expense away from it, it splits in half. So the company then doesn't look anywhere near. I've only gone back to 2019 as well, which is when IFRS 16 came in, but all of a sudden the company doesn't actually look as great. And I've also had to do it in my this was my standard net present value calculator, just for the cash flows, what the cash flows would be, present value, future cash flows based on the discount rate. And then I've done a Monish per one as well, where in the nth year, so either in this case year 5 or year 10, you sell the business for this multiple, and then that is added to your free cash flow figures. That's how he said to do it in his Dando Investor. And then I've also got I use a Joel Greenblatt style earnings multiple, which was taken from the Lear Corp lecture that Richard Bzina did. He's basically like averaged a 3-year operating margin, figured out what potential future EBIT is going to be against potential future revenues, minus the interest expense from it. Got his, despite divided that by the share count, got his future EBIT per share, and then see what the earnings multiple is on that. Pardon me. And then I've also done that with free cash flow as well. So a future earnings multiple, because that is very, very similar to the earnings one, to the EBIT one. But obviously, when it comes to the free cash flow side of it, this free cash flow would be wrong because it doesn't factor in the leases again. So I've had to come down here and factor in what the leases are, and then all of a sudden your future free cash flow multiple, say you were going to, I estimated that you would make about 520 million free cash flow with leases included in that cost, as in like not subtracted. You get a 4.6 multiple, and all of a sudden it looks very cheap. But when you actually subtract the leases from the future of the simple free cash flow, all of a sudden it's a 9 times multiple, so it doesn't look so cheap. Now, I got quite excited about B&M to start with until I remembered that IFRS 16s had some sort of impact, and I had to dig into the weeds and see what was going on. So now I'm not so hot on B&M, I got to be honest. I think it is probably slightly overvalued. What's the historical lease adjusted free cash flow multiple? It's now higher than what it was in 2023. That's a bit difficult here because this is when COVID was, and B&M don't really have an online presence, so their business was materially impacted during COVID. But I believe they were one of the companies that was allowed to stay open, if I remember rightly. But all of a sudden a 9 times multiple doesn't look that amazing, and then obviously it's got debts as well. Its enterprise value is reasonably high compared to the market cap, like double. So it's a very difficult one. There are still some questions to ask about this, and it's whether or not as well they've got any comparative companies that are actually floated. So we'll look into that. But yeah, start with very excited about B&M, especially when you see the price. This sort of sell-off is and because you're around historical lows, this sort of sell-off normally you think, oh yeah, this could be good if the business could turn itself around. But at the moment, it doesn't look too great, I don't think. But that's what we're here to find out, aren't we? And here to look into it. What I did notice on here though was that Deutsche Bank actually has can't speak today, has put a potential buy rating on B&M. Down under here. So it's been one of the weakest performing stocks under our coverage this year. Combination of structural fears, growth of the discount category, and earnings disappointment. So basically there's more competition, and they say the earnings weren't as good as what they wanted them to be, even though it's green on here. So the revenues were slightly less. Be there. So down 34% year to date, but obviously you can see the decline is larger than that over the last 14, 15 months. 60% down. So looking at our new retail framework, B&M scores well on a number of financial metrics with robust cash generation and a good return on capital employed, and looks cheap on most valuation metrics. So in my analysis, the return on capital employed has dropped significantly. Bear in mind that all of these ones down here are lease adjusted. So compared to what it was, it's not as good, but I guess for a budget retailer, 15% return on capital is still quite high. Let's see what else they've said. Therefore, the question boils down to structural metrics, where it is a relatively low market share, has a lack of online business, and is exposed to lower income demographic. In times like we're having in this country at the moment, where the economy is dog shit, in that statement to me is sort of like, well, surely you could actually pick up more business in people that were in the so-called, higher band of purchasing of retailers. They're going to lose people because they're going to want to spend less money. So someone like B&M that's so-called one of the lowest rungs on the ladder as regards to where people shop, at least that's the perception that this is putting across, then surely they can actually pick up more business when the people that are in the higher rung are actually going to be like, no, I'm not paying this much. We can't afford to pay this much. Let's go to a cheaper place, you know? So, you know, B&M could actually benefit from that, in my opinion. He added that the return of food inflation may be relative benefit to B&M, given its 20 to 25% exposure in this area, and also noted that the retailer's homeware category remained robust. So there is a level of robustness about it. Obviously, the free cash flows have dropped, but like I said, this is 20 million higher than what current. The current one is 4.53. I think the current lease expenses percentage of revenues. So, you know, it does take a whole number. You know, if you go from a 9 multiple down to an 8, it's not significant, right? If you want to make a lot of money, every value investor that's done it has told you you've got to be looking at multi-baggers. You have to be, because you're going to be wrong far more than you're right, even the best. I'm sure Monish Pabrai said, if you look at Warren Buffett, you know, the greatest value investor of all time, he's only made about 12 investments that materially move the needle for him. And that's the greatest value investor of all time. So where are the rest of us going to, you know, stand with that? So yeah, find something because it's going to go up one multiple more is not going to get you in the pantheons of great investors. Unfortunately, it's just not. And that is obviously where we want to be. If we want to do this full time, you know, that's where you got to be aiming. Doesn't mean that you're going to succeed. You're probably not. 95% don't, and there's a very, very good chance that I'm not, because like I said, it's only 5% chance that you will make it into that category. But you have to be looking at the multi-bagger stuff in order to get returns like that. You know, you have to be looking to hold stuff for years as well, as opposed to getting quick pops. So yeah, currently it doesn't look very great. The only thing, right, with this here is that I know that the lease expense last year was less than this. So because revenues were higher, it sort of affects it the wrong way. So the multiples here is also wrong. It's just something I got to bear in mind, but I'm just trying to be as conservative as I can across it. But at the moment, to me, it's bordering on the upper band of fairly valued. From a fundamentals point of view, I could be wrong. You know, all these free cash flow margins as well are unfortunately not correct. I haven't added one in down here. Actually, maybe I'll end up having to do that, just so for lease stuff, heavily leased stuff, I can put different free cash flow margins in. To be honest, that actually makes more sense. I'll make a note of that now, and I'll do that off screen. But yeah, so they've given. Why didn't that pop up then? They've given future guidance. New chat. Hang on. Right. They have given what is BME.L's future guidance. So they do it all on adjusted EBITDA, annoyingly. So I've got a funny feeling it was 605 million EBITDA. Where are we? Is it going to state this, or have they not got it? I'm sure it was 605 million. I don't want analyst guidance. I want their own. What have they stated? No, I don't care what other analysts say. The only thing I noticed here as well is on this list of these other funds and all that, saying what's a buy and all that. So they've got Dunelm as a buy, raising its price target to 13.20. We put Dunelm in here, DNLM. 13.20 is what there. It's a 13% move. Like I said, if you're not gonna, to me, it's not enough. I would not even if you want the high returns, you cannot be looking at stuff thinking, oh yeah, 30% move, that's really good. You just can't. Like every successful huge value investor tells you that. So to me, a lot of it is just, pandering to the get in, get out crowd, you don't leave yourself any sort of leeway in that style of investing, I don't think. As Lee Lu stated in his lecture with Bruce Greenwald, though, is the market set up for the people to get in and out trading. It's not actually set up for investing. Where were we anyway? B&M. So yeah, EBITDA of 620. So the no, hang on, there go 605 to 625. So we're going to use the 605. Well, we know that there's going to be another 200 million, 250 million, at least 250 million, 260 million of lease expense to go on that, because lease expenses obviously are hang on, what am I trying to say? They're depreciated, aren't they? I've made notes on this. Hang on, let's see if we can find the notes. Where would I have put the notes? Let's have a look. Is it down here somewhere? What did I do with it? Don't tell me it hasn't saved. I tell you where it is. It's in my notes section of my spreadsheet. Here we go. So, companies, here we are, we're reading this bit here, only post forward EBITDA guidance at some companies, including B&M, this is, so adjusted to pre-IFRS 16 levels, which is fine, right? Because that means that they can then compare it to previous levels. So they issued 620 million guidance on the lower end. Lease expense in the annual report was about 253. So this was for full year 24. So the true EBITDA was actually in the mid 800s range. 844 it came out as. This is actually quite annoying as well. And I know we're going off on tangent after tangent here, but in not having the lease expense in the operating side of things, it boosts EBITDA. So for companies that are incentivized their management by EBITDA, getting a good EBITDA, all of a sudden EBITDA looks miles better than it actually is. So let's say they had 844 million of EBITDA the true EBITDA, when you add in the lease expense, which I got a funny feeling is true EBITDA up here. Yeah, 844. It says 844 on Yahoo as well. Let's just get this up and show you. B&M.L financials. Expand. Don't need to expand. EBITDA there, 844. That's with the lease expenses included. Now, after that, onto this. 844 million of EBITDA, and revenues were 5.5 million. So I've done it. So we've made an EBITDA margin then. So 15% of revenues was EBITDA. So what I've done then is the 4-year financial year 2025 guidance. Like I said, we've just seen a 605 million. So if I add back 250 million of lease expense to get the true EBITDA, then that would give you 855 million of EBITDA. If you divide 855 by the average EBITDA margin, which was 15.1%, like we said it here, you'll end up with estimated future revenues. So the estimated future revenues are slightly higher from me using this, which is actually, I ran this all through ChatGPT. So my estimated future revenues are around, from using this approach, adding the lease expense onto their adjusted EBITDA, using the average EBITDA margin, dividing the true EBITDA by the margin, you will then end up with what the revenues are likely to be. Now, I got a funny feeling they forecasted revenues to grow by like 1%, less than 1%. So that is very much in line doing it this way. 5.6 billion compared to 5.5 billion last year. So to be conservative again, when I've gone to my valuation, I've actually only put 5 billion in, even though we think it's going to be higher than that. I mean, we could go to 250, I suppose, but when you start getting close to what they are, I've done that wrong, haven't I? It's one too many zeros. When you start getting close to what the actual estimate figures are, if there's a surprise, you're going to get hammered. It still only takes it down to about 8. So you just by putting 250 million in more, it doesn't materially change the outcome of the multiple. And like I said, historically, the multiple, it just seems like it's fairly valued, even if revenues grow slightly, which is what they are forecasting. Your simple free cash flow is not really going to materially change. Your costs potentially are going to go up, but I think if you look at the historicals, the costs they're pretty consistent. One thing I will say about B&M is it seems pretty consistent, right? Gross margin has slowly increased over time. SG&A expense unfortunately slowly increased with it. That's just an outcome of the general market, though, I guess. The only thing is, in recent years, operating margin, so EBIT, which is before leases come into it, has slightly declined. So that's not too great. Current ratio is good. Interest coverage ratios, obviously that would change as well because of free cash flow. So the interest coverage ratio, if we're saying that free cash flow, actual true free cash flow after lease expense is almost half of what the unadjusted IFRS 16 free cash flows are, then interest coverage is just over 1.5 ish, 2. So it's good. It's enough to get you through. I've got a funny feeling I've read somewhere, or I've heard Monish Pabrai say that he generally wants a coverage of at least 3. So you're in the ballpark. It's not too bad, but I don't know. I just don't think there's enough here currently. It's a very difficult one, this one, because when you look at this, you think, wow, look at all that room for improvement. But the UK economy at the moment is not great. I think the 30-year gilts are now like the highest they've potentially ever been. Liz Truss was forced out of office when they were like 50 basis points lower than they are now. So the outlook for the UK is not great, and obviously retailers and all that will take a hit on that. B&M's a difficult one because I would say the majority of their products are not necessary. They sell the same sort of things that you get in supermarkets, but then there's an awful lot of other stuff like stationery and like a few toys and all that sort of thing. It's a bit of a mishmash store. So it's not going to fare as well as, say, a Tesco's or a Sainsbury's, or, a supermarket would, where your sole business is effectively food. Everybody needs to eat. It's not going to do as well under tough conditions as a supermarket would, for those reasons. So for me, at the moment, I'm not really interested in B&M pre the IFRS 16 debacle. It looked very appealing when you dig into the weeds of IFRS 16 and actually realise that the free cash flow is inflated because the lease expenses are missing. It doesn't look anywhere near as great, in my opinion, but it is relatively consistent. 300 million in free cash flow it's not to be sniffed at. What was the potential present? So next year, around about 300 million again. It's certainly not to be sniffed at. It is a consistent retailer. I know that Deutsche Bank was saying that there are other people coming into the territory, which there are. I would imagine they would go up against other companies like The Range and people like that, but I don't know that The Range is Actively, I think it's a limited company, so no, very difficult then to comp this against what is probably one of its main rivals, because there's no, it's a privately held company. So for now, I will keep an eye on B&M. I will put it in my watch list, which is blue, because this here is, is not to be sniffed at should it come around. But currently, don't know. It doesn't look great. They do pay a dividend. Wrong one. Let's just zoom it out. So the dividend's not to be sniffed at as well, mind. Where are we? Down to here. It's a pretty decent dividend, I will say. I got a funny feeling it's around about 10% at current prices. It's last few years at least historically consistent dividend as well, actually. So current price is around 241. I should be able to do this maths in my head, but I'm just going to use a bloody calculator. 0.3 divided by 2.4, 12% dividend. That is not to be sniffed at. You hold that for 3 years at this price, that's a reasonable gain. And I guess as well, I suppose, if you look at it from that point of view, any potential increase in this has obviously got to be added to that. It's whether or not they can continue with the dividend. It's whether or not they end up picking up more customers from people that have, dropped down from more expensive retailers because they want to save money in the current economic climate, or that's why it's on my watch list. I'm not entirely against it, but at the moment I am not entirely for it. I think there's too many what ifs, potentially. So obviously none of this is financial advice. Do not do anything. I don't know what I'm doing. Like, that's the whole point of this series, is vlogging my journey of trying to know what I'm doing, from nobody to hopefully one day being able to do this full time. No qualifications, no nothing. Do not listen to what I say. Effectively, I'm just voicing my opinions, vlogging my journey, and there we are. But B&M to me is potentially one to watch, but not right now. The problem as well is that the majority of their stuff is leased, so their book value is awful. I know I've said before, I need to go through stuff in a formulaic way, in which generally I would start on the business model and then the balance sheet. But because I've already looked into this, I'm just sort of given a breakdown of what I've seen with B&M. But yeah, they don't own enough. Should shit hit the fan, they don't own enough stuff. Total assets 4 billion, total liabilities 3.2. Got 1 billion of that in goodwill, so automatically straight away, you potentially company gets in financial trouble. There's no way to sell real assets to cover the debt. So what is it? The total debt. This includes lease expenses, though, I believe. So obviously it's not as bad as that. Let's pull the financial statement up and just have a look. It's here, isn't it? Where is the balance sheet? There. So lease liabilities, I guess actually the majority of their debt. So, pardon me, interest-bearing loans and borrowing, they've got about 1 billion. So in order to survive a major downturn, they've only got about 1.6 billion in property. So basically the company would be decimated if you were to do liquidation value analysis on something that's this heavily reliant on leases. My opinion. If I'm wrong, please correct me, as always. But yeah, I'm going to leave B&M here for now. But for me, it's definitely one to watch. The dividend's very good. the revenues are reasonably stable. I know that it seems a lot of that price increase was because of some revenue growth over time. Nothing's going to grow forever. You're going to saturate your market. People's going to end up looking at you thinking, oh, that's a good business. I want a slice of that, which obviously takes away your revenues as well when competition comes in. But it's a consistent company, which is for a value investor, I suppose, is something that you really want. You want consistency. So it is a consistent company. Revenues are reasonably consistent. The margins are reasonably consistent. The free cash flow, when you adjust it, is still reasonably consistent. Your multiples are reasonably consistent. Like I said, this is massively overstated by about 100 million. So if that would, bring a multiple up again. I can't see it currently really as anything other than fairly valued. I'm not entirely sure how it made the heights that it did when revenues are less or are more now than what they were back then. And the margins are very similar. The only thing I can see that got the price that high was the fact that revenues were growing and people are jumping on the bandwagon of, oh, is this a growth company, But the dividend is something, it's not something to be sniffed at if you 10% dividend at current prices. So definitely one to watch for me. But at the moment, I just think the climate in the UK is too unpredictable currently. To bet on this, it's not got the power and the survivability of a supermarket, because a lot of what B&M sells is not fundamental to day-to-day living, and there are a lot of people now, I would imagine, are purely looking at buying things they need and only things they need. So, is what it is. Enough waffle on this one. Spent half an hour or 40 minutes on something that, to effectively tell you that I've come to a no on it, which I guess is wasting the time that I said I didn't want to waste anymore. Another big one here, which is huge. Greggs, like I said, is an institution for the UK. At the moment, though, it'd be like catching a falling knife. So for those of you that don't know, I'd imagine as well, Greggs is another one that's heavily lease oriented. So we'll have a look. But GRG.L. This, like I said, this is my quick take spreadsheet. Doesn't look great, does it really, to be honest? Using simple free cash flow, it'd take you 20 years to purchase. There's very little debt, though. The market cap to the enterprise value is very good. So for those of you that don't know, Greggs is like a baker's in this country. It's not a fresh food baker, but it's a... I'll say that. I'm pretty sure they sell fresh sandwiches and stuff like that. But, the sausage rolls and the pasties and all that, they're not made in store like a traditional high street baker would in this country. But everybody loves Greggs generally. They are all over the country. There's 2,200 shops and 375 franchise locations. So Greggs is a UK institution. I don't know many people that don't have a favourable opinion of Greggs. We've got one over the road from where I work, and people go there every day when we're on shift. Going to get a Greggs. Do you want one? Go and get a Greggs. So it's a UK institution. It is heavily ingrained in our society now, Greggs. But the stock price has taken a shellacking in the last 18 months. So it's worth pulling up. Very difficult, right? Because Greggs was growing, and it had been growing for a long time. It has been getting into the lexicon of British society. That said, it's an institution now, Greggs, in the UK. People will pay higher multiples and overvalue that sort of thing. Yeah, when stuff is growing and when the the visuals of the company is good, everybody wants on board. So it's determining whether or not the price was that high because of that, or the price was that high because it warrants it, you know. So Greg's is the one we're going to get up now. It's just whether what financial, let's get rid of B&M, Greg's investor relations, Greg's corporate, have they just done an annual report? Because investors overview, what am I doing? Share price results there, right in front of me. Annual report. So it is the annual report. Okay, so I can just drag this one straight into the spreadsheet that I'm on, because I've had to make another spreadsheet for annual stuff. The UK only releases semi-annually, and some of the semi-annual figures I found to be not entirely accurate. I am currently in conversation with Y Sheets about it, so I'm interested to see what they come back to say. But because it's an annual report and it's Q4, I can just drag in the annual report and have at it. So what was it? GRG. I've bloody forgotten already. GRG, yeah. So GRG.L, because it's a UK company. Right, and let's get Y Sheets up. Annual report, GRG.L. Oh, that's not a dot. There we go. Annual report. Drag it in, and we'll dump it in the spreadsheet. So here. Oh, bugger. That's the microphone in front of my face again. I don't know how long I can keep using that as an excuse, but I'll keep trying. I haven't got a camera at the moment, but I will potentially get one eventually. But as you can't see, but the microphone is literally right in front of my face, so I can't really see my keyboard. Right, so I've explained what Greg is. It's a baker. There's a lot of them. I would imagine, let's ask, but I'd imagine that's almost a sole form of income. There's probably not. They do some. They do merchandise. One of my friends has a Greg's jumper, and I'm sure another one's got Greg shorts. They do merchandise, but it's going to be a small portion of their earnings, you know. So what have they got down as their highlights for 2024? Is that this? Is it? Are we on it at the moment? Where does it start? When did Greg start? 40 years ago. So 1994. So they've significantly grown over the last few years. 500 shops to over to almost 2,500. So they've significantly grown. Okay, so this is the highlights thing, is it? They're just telling us what they do. 2,600 shops. Like I said, it's an institution. Everybody in this country's heard of Greg's. Everybody. Let's get down to the financial statements and the balance sheet, and let's see what we're looking at. Revenues are going to be consistent. One of my questions here, you can't see it, but I got a checklist on the background of my screen. One of the first few questions about the business model, where revenues come from, breakdown of the segments. Revenues, are they contractual, recurring, or seasonal? Greg's will just be consistent, unless people, Greg's will get hit by a crunch. People will want to spend less money. It is one of the cheaper bakers out there, I believe. And it's food as well. But they will get hit in a crunch because it is still cheaper to make buy your own bread and cheese and all that. Probably not a lot cheaper these days, but it still is. So they will lose business in tough times. So, like I said, breakdown of revenue and locations if they're international. Risk profile for the company, what the future company sees as future risks. and then basically once I've answered those questions, I'll move on to the balance sheet. Because for me and most value investors, the balance sheet is the most important thing. You need to know what the company's physical assets are worth, whether or not it's got any debts, whether or not it's going to survive. We can tell by the enterprise value of Greggs that it's not got a lot of debt. So let's get ChatGPT up, start a new conversation because we want it all Greggs specific. GRG.L Greggs bakery. Break down their revenues and their revenue locations. Right, we'll just ask that for now because, like I said, I've explained what the business is. We don't have to ask what the business is. The only reason I do that is for some American companies, and that's because I don't know them. Trailing 12 months, revenue's down slightly. That was a big deal as well. I remember it was on the news that Greggs share prices tanked here because revenues were down slightly, and that either shows you that it was massively overvalued in the first place, or there's a huge panic, you know. So 2024, you've lost like what, 6 million, and then there's a sell-off like that. So company mated, so they own shops and franchises, 1.6, covering franchise and wholesale partners, including license fees. Yeah, so that is another thing actually, is you can now buy Greggs products in supermarkets. Greggs will sell like frozen pasties in Iceland, which is one of our frozen food supermarkets and stuff like that. So own shops is about 89% of revenue. 2.4 billion. What's the revenue I got on here? Is that 2.4 billion as well? Yes. Oh, sorry, 2.014. Yeah. So that's correct. Where are we? This one here. It's not going to be. I can't see this as a company that's seasonal. It's definitely not really contractual. There is a portion of it, I suppose, if they're selling frozen products to Iceland and all that, that's contractual, but it's going to be a pretty consistent earner. There's not going to be a lot that shakes the earnings of Greggs other than an economic downturn and people deciding they're going to take sandwiches instead of go to Greggs, which some people will never do because they'll just be too lazy to make their own sandwiches and stuff like that. So it's a stable business, in my opinion. Geographic spread, all of Greggs' revenues from both retail generate in the United Kingdom. So I don't know if that includes Northern Ireland. I'd imagine it includes Northern Ireland. Retail 89% of there. So yeah, provide a modest contribution of 10%. All revenues are UK based. So yeah, so that answers basically most of our questions. How does the company make money? Let's get onto the balance sheet and see. Already got it open. Where are the financial statements? The revenue, balance sheet. So this is another company that's going to be the simple free cash flow is going to be heavily affected by leases. I would imagine. Current lease liabilities 53 million. So what we got? Intangible assets. So the intangible assets isn't too bad. No goodwill by the look of it, which is good. I say it's how you value these intangible assets. Generally, I assign no value to them, but Greggs' brand has value. Yeah, difficult one with that. I still assign no value. My general position is assign no value to intangible assets or goodwill. Generally, goodwill gets written down unless you're very, very good at purchasing. And intangible assets are very difficult to value. It's at the end of the day, it's worth what someone's willing to pay for it, and to take that at face value on the balance sheet for me is not good. 125 million in cash. So in the current assets. So what are their current assets? 242 million. So half of their current assets is cash. They've got 600 million in over 600, almost, 664 in property, plant and equipment. Right of use assets would be leases. Payables are 243 million. Lease liabilities this year is 53 million. So lease liabilities last year 52 million, gone up slightly. What is that as a portion of revenues? Where is my calculator? I got a funny feeling for Greg's it's not very high. 53 divided by, was it 2014? So around about 3% of their revenues goes on. Oh, it doesn't yet, because we've got to look at it in the cash flow statement. All right, this is the current lease, but what did they actually pay in leases? Repayment of leases 56, right? So slightly higher than that 53, but it's still going to be around the 3% mark. 56.7 divided by 2014. Yeah, just under 3%, 2.8%. So as we now need to adjust free cash flow for leases, let's put that in here, and I'm going to say 3.2% just to be, because we don't know what's going to happen in the future. I just put that in now for when we get to it, but yeah, so the balance sheet looks reasonably solid. The book value per share is 5. Obviously we're trading 3 times that currently. Tangible book value, very, very similar, because they've got very little debt. Do they pay a dividend? Yes, they pay a dividend. That is a good dividend last year, mind, compared to the year before. So what is an unleased? One of the things I've seen Roaring Kitty do, right, is he works out what the book value is minus the leases. So what is the cost of the lease liabilities in total? Problem is, it also depends on what the leases are. Are they operating leases or capital leases? Number 11. Where is number 11? Number 1. So we got a bit way to go. 12 went too far. 12, 11. Do they not? It doesn't appear that they break. There's a difference between the two, so we're probably just going to have to use all of it. Right. Okay. We're just going to have to use all of it. Back up to the balance sheet, wherever the hell that was. There. So 53.8 plus what's the long-term lease liability? 361.3, 361.3, 415.1. Where do I want to put that? In there. TTM, operating lease liability. We don't know that it's operating lease, but that's million as well, isn't it? So that's billion, went one too many. Wrong. So without the leases, the book value is almost double up here. TTM book value minus operating leases, so it's almost double. That shows you how much the leases change book value right there. I said the assets are generally good because there's only a bit of intangible. 24 million intangible assets is quite negligible. So the book value is pretty solid, which is why, what's the return on capital? Unlevered, around about 20%. Sorry, lease, this with the lease liabilities, and without the lease liabilities, 1%. Wow, that has significantly dropped it. Interesting. That has significantly dropped it, the return on capital. To go from 14% down to 1, 578, which is that. Yeah, well, this, look at what their free cash flow was last year with leases taken away, and the year before, and the year before that. This is COVID though, so, you know, difficult to, everybody came out and all of a sudden everybody wanted, you know, missed their vices and all that sort of thing. But yeah, 97 million, 58 million, 11 million. So that decline is not good, is it? That's a bad thing to see in a business. It depends, I guess, on what is causing that. What is different on the cash flow statement this year to last year? Because I said the balance sheet's pretty good. There is there long-term debt or not? No, it doesn't appear like they've got long-term debt. The debt is majoritively leases and obviously payables. So yeah, the balance sheet is solid. I think it is solid. The problem is the cash flows are not great. So 310 acquisition. Have they been acquisition heavy then or not? What was it saying the cash flows were last year? 310 minus 189. There's 40 million lost there. But the actual cash flow from operating revenues is the same. So is there a 40 million difference? Do they pay sales of own shares? Doesn't say purchase of own shares. Right. So what was the free cash flow last year? 116 million. There's 40 million drop there. So straight away, acquisition of properties, 40 million drop, minus the lease expense, and all of a sudden you're in trouble. Now, is that recurring? That's the next question. Probably not, unless they're still trying to aggressively expand. But there's going to be very few places now. I don't know what there is in my village. A few hundred houses. There's a Greggs in my village. There's not going to be many more places. They're saturating the market. Let's put it that way. Right. Problem is, there's no statement. There's no note for that, unfortunately. What have we got under acquisition in here then? Because I want to know what they've purchased for that. Is it just Greggs supply chain has evolved through acquisition of regional bakery businesses. As recently as 2015, a typical Greggs manufacturing site was making almost every one of our products on labour-intensive production lines. Today, a consolidated and centralised model has seen a step change in our cost structure. Okay, but what has balance sheet, capital expenditure? In line with our plans, we invested a total of 249 million in capital expenditure during 2024. Retail, so oh good, it's going to tell us hopefully. Retail estate expenditure grew as we increased the number of company-managed shops, openings and relocations. So that's opening more locations. It's just how many more can they do? That's the question. We also rolled out additional equipment to support our sales growth, including ice machines, and provide a new range of over-ice drinks to our customers. So they're increasing the product range. In our supply chain, we completed our commission of our 4th production line for our iconic savoury rolls and bakes in Newcastle. Battle phase of a lease site in Derby. Made some deposit payments in respect to the new Kettering site. Okay, so it's all based on growth. IT investments also increased. Depreciation and amortization on property, plant and equipment and intangibles in the year was 80 million. A further 59.2 million depreciation was charged in respect of our right of use capital leases. There we go. So they're effectively saying that this is our capital expenditures there. Previously communicated, our capital investment will continue at an elevated level until 2026 as we build additional capacity in our supply chain to support our ambitious growth plans. Okay. I mean, they only left themselves with like 10 million this year, didn't they? Whilst also growing and refurbishing our real estate In 2025, we will complete the work to bring to logistics capabilities of our new site in Derby and progress the construction of our new site in Kettering, having completed the purchase of the land. Okay, our shop opening and relocation plans mean that we'll invest in circa 160 new company managed shops in 2025 and refurbish around 120 existing ones. Wow, they're going big, aren't they? Pretty much every town's already got a Greggs. This is my thing though, you know, like there's such thing as too much of an aggressive works, you know, expansion thing. Modernise our older sites and introduce additional facilities to support our growth plans. In our real estate, we continue to target 25% cash return on investment on new shops and typically exceed this level after 2 to 3 years as the shop matures. Typically, the focus of the acquisition strategy means we are opening shops that trade longer hours and have higher than average sales and returns. The returns on newly opened shop remain strong, being mainly in new catchments. We have not impacted on the sale of other shops in the estate. So they're saying, yeah, return on capital, you know, they're saying the shop pays for itself within 4 years there, potentially faster. In our real estate, we continue to target 25% cash return on investment. So 4 years, that shop's paid for itself. That's pretty good. This level typically, so that's the problem. Like, say 4 years, because, pardon me, because typically is not a statement of fact, you know. Focus of the acquisition strategy means we are opening shops that trade longer hours and have higher than average sale returns. Returns on newly opened shops remain strong. I would imagine, though, that peters off once the novelty, that's the word, the novelty of it wears off. Then I would imagine the revenues of those shops will drop, not significantly, but I would imagine they would drop. Overall, expect capital expenditure in 2025 to be around 300 million, with the delay in purchase of the land for Kettering altering the phase of previous guidance. We anticipate the capital expenditure will be around 200 million in 2026 before returning to a normalised level beyond this investment. Where we expect maintenance capital expenditure to be up to 5% of revenue. That's interesting. So 6 or 7% of revenue. Conservativeness. Working capital. We ended the year group net current liabilities of 67.3 million as our cash and equivalents balance reduced as we progress with our capital investment plans. Okay, let's see how much cash reduced. 70 million. Okay. This is a difficult one, isn't it? Because the finances don't look good, but what they're saying sounds attractive. Stock and debtor levels increased primarily due to sales growth. Net current liabilities position reflects supplier funding as received payment from company managed shops, shop customers ahead of paying suppliers on standard terms. Yeah, pension scheme. Cash 4.5 million to a pension. As a result of scheme, net liability position of okay. Cash flow and capital structure. Net cash inflow from operating activities after lease payments in the year was 254.2 million after lease payments. Yes, so we're going to have to find the other one in a minute. What page is this so we know? Page 65 we're on. We go back to this. What was the before lease payments? Where am I looking? Oh, page 65, am I? Yes. That means the reports are up here further, surely. They're not that high up. Why can't I find the bloody reports? Maybe they're lower. Doesn't seem to make sense. Why don't I just read this? Financial review, financial reports. Where are we? Director's report, accounts. Consolidated income statement, page 128. So yes, it is double down. So we'll go to like 120-ish, have we? No. No. This looks professional, doesn't it? Trying to find a bloody... What are we on? 120, so lower. Here we go. Want the cash flow statement. 310. and then they've taken away the lease expense. So at least if you look at, this is the thing, this is why you got to look, you got to read, because you look at that and you think brilliant, and then their notes, what was it, page 65? Oh, hang on a minute, things are not as rosy as that shows. Like I said, because of IFRS 16, I don't agree with it. It's my opinion. There we go. So where were we? Capital expenditure of up to 5% of revenues. Yeah, okay. What are they must have guidance then going forwards. Say, maintain a strong balance sheet, reflecting inherent gearing of the group's leaseholds and working capital. We aim in normal circumstances to maintain a year-end cash net position of 3% of revenues in order to allow for seasonality in the working capital cycle and protect the interests of all creditors. So, you got 257. Yeah, that's 254, sorry. It sounds rosy, doesn't it? It's geared up to sound rosy. It sounds like they know what they're doing, which, to be fair, they must do, considering they've become an institution in this country. Delivering an attractive ordinary dividend. Now, what I want to do, let's see if it's broken down. Dividends paid, 106. They don't have, as far as I'm aware, do they have preferred? No. So they've only got one style of stock. So that dividend is the dividend, which was what? Where is the dividends? Pretty good. Quite high. Yeah, 6% ish. Reasonable. That's whether or not you believe in their growth strategy. Then ultimately, they've explained why free cash flows have dropped. What did they say they spent? Let's see if it's actually in line. It's got to be in line, otherwise they wouldn't have said it, surely. Don't believe everything you read. That's the thing. Where were we? Up here, when it's 60 something. 65? No, what's going on here? Oh, B&M, reading the wrong bloody one. Why have we still got that open? Didn't think it looked the same. 65, we were there. So, capital expenditure. Invested 249 million. Right. Get a cash flow statement back up, because I'm reasonably happy with the balance sheet. It's the shock of the cash that's, I believe, caused this, from what I remember it being in the news, caused the sell-off. 310, I said, it's very similar. 40 million difference, which they've explained, because they're growing, and will continue to try to do so. So you're going to end up with probably less next year, even if the operating activities are similar. 60 million-ish in leases. So what's that, 250? You're left with 20 million. What have I got down here then as the overall 12? So why? Oh, because my lease figure is higher, isn't it? My lease figure is higher. Yeah, okay. Where do you stand on that, It's definitely above liquidation value. What is it? Do they own the shops or do they lease them? Sounds like they own the majority of their shops, don't they? I can't bother to search through that. We'll ask ChatGPT. For the amount of businesses that they got, the leases don't seem too high, especially when you compare it to B&M. And their PP&E is quite high, isn't it? They're on their balance sheet. Do they own the majority of their premises? Because Greggs does not own most of its shops are operated under leasehold. Interesting. Okay, so I had that wrong. In my head, that was different. Probably plant and equipment is billion, mind. What is the current market cap? 1.6 billion. Okay. Greggs is an interesting one, isn't it? As far as I'm concerned. Have they given guidance on future revenues? I would imagine it's going to be reasonably consistent. Operating profit, but not revenues. 195.3 million. What was it this year then? I'm guessing they mean EBIT by that. Operating income. 195. So if that's what was it, 195 they were saying? Yes, so modestly down. Modestly down. While management has issued formal sales forecasts, their indication of long-term growth ambitions. Right. In that case, then you've got to go to the operating margin side of things. Average 3-year operating margin. This is only 80% of it as well. Gives them an earnings multiple though on EBIT of 5. What are they historically? EBIT. Is this the future? So next year we're going to say that. What's their EBIT this year? Let's find out what the EBIT this year is first. EBIT this year 209 million. I tell you what, then this is what's wrong. My revenues are completely bloody wrong. What's their guidance? Let's have a look. What was it again? So they're going to say they got 195 million. So 195 million divided by 0.85 would give revenues in the around about 2 billion range again. So we put 2 billion in there. It's slightly higher than that, but we're trying to be conservative. I'm getting my zeros all wrong today. We're trying to be conservative. 13. We're being conservative with everything here, mind, in that we're not using the true operating margin. We're not using the true free cash flow margin, although that's wrong because you've got to add the leases into that. 13. How has that done that? What have I done wrong here? Right, on an EBIT next year with around 2 billion and around an operating margin of around 8%. When was the last time they had lower than 8% operating margin there? So only 3 years ago, right? So the average over the last few years is 9. I don't want to use that. I'm not even comfortable using 8, to be honest. I think to be conservative, you've got to be lower. But it's trading at historically 9 times EBIT. So yeah, if it's saying next year it's going to be trading at around 13 times EBIT. What was it historically? COVID year aside, 20s, really? Really? Past performance is not indicative of future performance. But yeah. What are we saying? Yeah. Simple free cash flow, discounted cash flow over the next 5 years is $4 a share, $5 a share. It's about a third of the price. Is my net present value calculator here wrong? Because they're saying with leases it goes negative, and I guess it's because of my lease figure here, isn't it? We're going to say next year that leases are going to be in the ballpark of what? I'll try and figure out how I work this out again in a minute. Definitely not going to be that negative, is it? Surely, if leases are only 53 million this year. So my calculation somewhere is wrong on the simple free cash flow side of things. C6, which is revenues, times this future simple free cash flow. C2, where's C2? Right. And then what have I done after that? C for F37, which is that, minus C44. Where's C44? Future lease expense, 260 million. Ah, I have to do this myself. Hang on. This is where it's gone wrong. I forgot to remind myself that I need to fill this portion in. So this is me giving an estimated figure of future lease expenses. Let's just get it all so it's the same color. Save this. Right, I need to change this. Right. So what has, let's just have a look, lease expense been the last 2 years? We can only assume it's going to go up slightly. I think that's a conservative thing to do. Repayment of leases, so around the mid 50s. So if we say next year, I don't know, 6, because they're opening more stores as well, aren't they? That's going to go up. How many more stores? How many more stores were opened compared to the previous annual statement? Let's have a look. Not many. So materially didn't change. How many did they say? I'm going to ask this because I can't bother to look for it again. How many did they say they will open in financial year 2025? 140, 150. So to go from 31 to that, you're going to be looking at lease expense probably 65 at least going forwards. Has to be. You have to be thinking, what was the increase? The increase was, wrong one. Let's put that there because I'm going to keep doing that. The increase was 3 million on 30 shops. So interesting. So how many did they say they're going to open? Five times more? Yeah, 5 times more. So you're talking 15 million more just on lease expense. So it has to be, you've got to be looking at 70, a minimum of 70 million on lease expense. Then all of a sudden, your future free cash flow, conservatively, I will add, is materially different. I need to put some cash flow margin in here. That's what I'm going to do. I'm going to end this video pretty soon because we've been going on for a little while now, almost hour and a half. And then I'm going to change that to include a least simple free cash flow margin. And then I wouldn't have to keep doing that, would I? But yeah, the lease expense is going to go up. You cannot expect it to do anything else. So they're going to open 150 new shops, a minimum of 15 million, and the climate's different, so it's probably going to be more. So I think even 70 million, you're probably bordering on, is that enough? Which means you're potentially at 32 times simple free cash flow. What's the average free cash flow multiple? Materially changes. Obviously, it's very difficult, right? Because this is acquisition territory. The free cash flows and the capital expenditure on acquisitions and all that, once they've done it, is, I'm assuming, going to decline because it's just the maintenance cost of them. They've already said, what did they say? 5% of revenues is going to be the maintenance cost, didn't they? Am I right in saying that? Let's just check that. Oh, bloody hell. Did exactly the thing that I thought I wouldn't do. That's why I changed it around. 5%. Oh, we've got a lot of 5% to look through here. It's way down here. There we go. Maintenance capital expenditure should be up to 5% of revenue. So 2 billion in revenues times 0.07, because we're not going to take that. 140 million in free cash minus at that point lease expenses, which could be, so I don't know, they could have 70 million in free cash. Could have. This is all speculation. I don't even know I'm doing it right. What would the multiple be then if they had 70 million in free cash? What are you at the moment? 1622 divided by 70. No, I did wrong one. 1622 divided by 70. 23. Interesting. Greg's, I think, is another one that's going to go in the watch me pile. I put an alert down here because this falling knife looks like it's going to get to this historical level. And this is a historically significant level technically. Every time price has been here, there's been a lot of, movement around it. So I put an alert here to see, I'm not interested in it at this price. Their strategy seems sound, their business seems sound, but you're going to have some proof in the pudding, I think. Otherwise, you're just speculating on whether or not it's going to be a success, which is obviously a mistake to do. Interesting, though. Going in the watch list, which is blue on my thing. And like I said, I've put an alert on it just down here, just so I know that potentially it's getting cheaper. Can we? It's very difficult actually in the UK to figure out who holds it. Our stakeholders, 81. So page 81. I want to know, this is a problem with not having an SEC in the UK, and I'm just not familiar with what's going on here, where to find the data potentially. But I want to know who holds it, who holds the largest amounts of it. Can I find that here? Insider trading. Which one do I normally use for the UK? This. Greg's, GRG. I tell you what, I didn't do that for B&M either, actually. Let's do that for B&M quickly. Directed deals. This is the problem with the UK, though, is that it says buy, but they could be buying. I don't know if they're outright buys, and I don't know where to find the information to see if they're outright buys. In June, they were buying at significantly higher, Not a lot, though. But 14 shares is not even worth. I almost swore then, it's not worth a lot. This is different. Chairman at this time, It's still not a lot, though, is it? I know that this isn't America and there's less money over here, but what? Oh, I don't know, is that a lot? Or is this the the numerical value that he holds, or is that the, so say he bought 1249 times 16, it's only 20 grand, you know. It ain't, it doesn't make you think wow. But then a lot of UK insider buying, unfortunately, appears to be like that. It's not like America where you say, oh yeah, I'm going to chuck $1 million in this. Nobody else has done it either, right? We're this cheap and nobody else has done it. And they were only, you know, token buy-in here. And this is the problem as well, is are they buying, or are they buying, you know, it does say there, they might exercise of option. It's just finding the data in this country is a lot harder on UK stuff. Does they say any, can I see brokers? No. I'm going to have to go on Yahoo Finance, I think. Holders. This is just for B&M currently, quickly. American Funds Fundamental owns. I take it that's 3% of the business. You're not going to get any more than this, so annoyingly, but then none of these are significant. Nobody's really interested in B&M. GRG, Greg's. Let's have a look for Greg's. FMI funds again. Is this correct? Top mutual funds holders. Oh, yeah, but I want hedge funds. Top institutional holders. There's got to be a better way of insider transactions. And that's 6 months. 26,000 here. Is that the same one as that other one? Matthew Davies? Yeah. So they're saying they bought it at 1,600. This is saying, I don't know, is that pence? Got to be pence in it because all UK stuff's in pence, which means he's basically given them total insider held shares held 5.46 million, which is nothing compared to how many are floated. It's not significant. I don't know. I'm going to have to Google off screen because I'm not going to do it now because it'd just be shit for the video, but I'm going to have to try and find out better ways. America's amazing. You've got like Open Insider, you've got Whale Wisdom, you know, they state all that stuff. I'm sure it must be in the financial statement. Got to be. Let's have a look. Oh, can I click on these? Bloody hell. I've been scrolling up and down it, and you can do that. What a knobhead. Our stakeholders, yeah. Like I said, there's nothing in there though. I want a breakdown of like who owns what percent of the company, and you want to give yourself some confidence, you know? Our people, sustainability, financial review, risk management. What do they see as future risks? Do they say that? Zero controls, climate risks. Our climate-related risks are captured in consistent manner. Emerging risks. Just says how they look for them. Right. So at the moment, there's no... I could be wrong. I can't see a breakdown of who owns what, which is what I want to know. And there's nothing lower than that. All right. I'm going to go off now. We're going to finish this video here. Interesting. Oh, really knocked something over. Interesting, but is it investment worthy at the moment? I think both of them have got material risks. Greg's is potentially not cheap enough yet for the money that they're going to spend. Although the 5% of revenues in the future of maintenance capex, once they've so-called finished their deal, is reasonably interesting. yeah, the good thing about these videos is that I can come back and watch them and know my, I can see my thought process though as well, which is hopefully the point for other people if anybody ever stumbles across it. But yeah, like I say, I'm going to go away. I'm going to try and find a good way to find actual insider purchases and institutional owners. I want to know that as well. See who else thinks. I've got a funny feeling you can do it on. Where were we? I've got a funny feeling you can do it on Ticker, but it's all locked. I haven't paid for it, so it ain't going to be helpful. Estimates, transcript, ownership. Yeah, all locked. See, Schroeder Investment. Is there any names here, though, that I know? Not really. Okay. There must be a way to find it out. Must be for free, hopefully. Insider transactions going to be locked as well, no doubt. Even load in. I have got other insider. Is it Market Beat? AJ.L, investment firm in this country. Can I search? Not by the look of it. Directed deals. Open an account. So you've got to do it by opening an account. Any more? London Stock Exchange. Just see what they've got. Search for quotes or documents. GRG. I know I just said I was going, but let's just do this quickly. Couldn't find it. Oh, it's not going to be .L in London, though, is it? Greg's PLC. Fundamentals, analysis. Where's it going to be? So this is people's trades of it. Director, PDMR shareholding. What's that? That's them telling that they bought something, isn't it? £16. So yeah, okay. So they acquisition of ordinary shares. There we go. So that was a buy. That's interesting. At least I know I can find that on the London Stock Exchange website. The only other problem though is how do I find the insider owners? Is it possible? Not by the look of it. Let's ask ChatGPT. Is it possible to find insider owner and institutional ownership on the London Stock Exchange website? Major shareholder, significant shareholders. Where's that then? Profile page shows significant shareholders above 3% disclosure. Where? Where? Might as well continue showing this because this is something that other people might want to find, you know? Certainly can't see it there. Analysis. Headlines, we've got that. Got that. Where would I find that then? Okay, can someone show me? I can't find it. Where? For a complete picture, investors typically check Greg's investor relations site. Is there a significant shareholder list on that? Potentially. Director Insider LSE also lists directed deals, board insidership when directors or person these show up in the registry. However, LSE does not provide a full percentage breakdown of insider versus institutional ownership. How do I find? I find the significant shareholders section. Oh, shareholders section. All going well. Section on the LSE website. London Stock Exchange, search bar, yeah. Overview, news, RNS financial section for significant shareholder. There isn't. Unless I'm being blind. There isn't. Unless you've got to pay for it. Overview RNS. Finance shareholders is not a tab. So it's no longer directly listed. What a bugger. Must file all holdings in company RNS. Okay. Go to Greg's, click the link RNS, use the filter for holdings in company. You know what I do again? I forgot that already. News and RNS. That's here. Show more news. And there's no filter. Unless you just got to search it. There's no filter. All right. I'm going to do this off camera because now it's just getting into boring and non-learning territory. Greg's, when I find it, I'll let you know and we'll continue. But for now, please like and subscribe. Please don't take anything I said as advice or seriously at all. I don't know what I'm doing. I'm trying to figure it out. I'm just vlogging my journey. I'll see you on the next one. Thank you very much.